Saylor had this quote this week, and it was on Fox Business. He said, as long as Bitcoin keeps going up 1.25% a year, the company can pay the dividend forever. And I loved it. I was like, oh my God, I want to do the math. Right. So I did the math, and this is what the math looks like over here on the left-hand side. And this is just really rough, or like basic. I have no idea what Saylor is looking at and exactly how he's calculating it. But and I figured we could go through some spreadsheet stuff, because you could think about how long this company is going to be around, even if you think the Bitcoin CAGR is 1.27%.
I'm excited for this because that just doesn't make any sense to me right from the beginning. I'm like, wait, how is that possible?
Yep.
So
Wait a second.
show us this math. I got to see this.
Wait, but hold on a second here, Jeff. What you did on this chart on row 18, you've got a line, and then it jumps to row 104, and those are years.
Those are years, yeah.
Right, yeah. So I've never seen this chart before, but what you're showing here is that the Bitcoin declines at what? You said 1.25% in the formula? 1.27% CAGR. Oh, it goes up by 1.27. Right. And then he would sell that 1.27% to pay it. And you're showing there that he still has 177,000 row 113. He still has 177,000 Bitcoins, or right there.
Yeah.
Oh, that's Bitcoin held. And then the net Bitcoins are last column, row I. And so, folks, look, if somebody creates an Excel spreadsheet and you've never seen it before, but you can then speak to what it says, and Jeff, if I got it wrong, chime in.
No, you nailed it.
You're showing the loss between column D and I is the 1.27%. Correct?
Not quite. And
okay, go ahead.
I'll walk through it. So you've got Bitcoin held at the beginning of the period, right? So you've got 649, almost 650,000 Bitcoin. Bitcoin price at 92,500, and that's about where we're at right now. So 60 billion worth of assets. And then I just assumed the $750 million dividend payment just comes off the top, right? So that just $750 million just paid out once annually to make the math simple and just make it so I didn't have a 10,000 rows. And so the net assets is just, okay, what if I sold that amount of Bitcoin to pay the dividends? And here's how much net BTC in fiat dollars you have afterwards. That's column H. And then what is that in the value of Bitcoin, column I? That's just taking the assets divided by the Bitcoin price in column E. So you get to 641,000 Bitcoin. And so that number starts over at the next row. So you start with 641,762, and you go through the same math. But in each year, so starting in 2025, next year, 2026, the price of Bitcoin goes up 1.27%. That's what I've got outlined here. So next year, 2026, the price of Bitcoin goes to 93,675. 27, 94,864. And what you'll see is, if you run the math here, and I'm just going to scroll down. So actually, hold on. Let's fix the year column here so you can see. View, freeze panes. Cool. Okay. So and you can look at this net BTC column to see if you run out of Bitcoin. So you can see, you keep going down here, net BTC column, you're never running out of Bitcoin. You're going down, and eventually the price of Bitcoin gets so high that your dividend payment trends to zero. And that's, what are we, 950 years in, the year 2,973.
And you just gave up?
I stopped because I guess I could just drag this down further if I wanted to. But and I think the most fascinating thing is, even if you take, maybe I'll just drop it to 1.25, what Saylor said. When you get down there, I think with the 1.25, I got it running out in the year 2390, but that's probably just, we're talking very small very small delta there. But the really interesting
payments get paid.
Yeah. What the dividends get paid.
Dividends get paid even if Bitcoin doesn't really compound. That's effectively the over collateralization, which is not present in any other financial institution. During the 2008 financial crisis, Lehman Brothers had $280 billion worth of outstanding liabilities and 260 billion worth of outstanding liabilities and 280 billion worth of assets. And so they had so that's 20 billion worth of shareholder equity. When those assets were repriced down just 4%, all of the assets technically owned by the shareholders and the debt holders were completely wiped out. So in that scenario, the preferred stocks went to zero, both the cumulative and non-cumulative preferred stocks went to zero. And in this case, that's not the case. For the shareholder equity and the debt liabilities, effectively the prefs and the converts, to have no claim over the Bitcoin would need to fall by 5x or roughly down to like 15K and stay there. And then, and stay there. It's not an actual professional liability. And then they'd have to face bankruptcy. So a bankruptcy proceeding. So the 2008 financial crisis is much, much, much different for those cumulative preferred stocks. And I think that's a lot of the fear in people's minds with these preferreds, is because really the entire precedent for these stocks are from financial institutions and then also utilities companies. But there was a huge, huge problem with these, both cumulative and non-cumulative preferred stocks, going belly up during the financial crisis. But you have to understand those companies were levered 21 to 1 as opposed to 1.2 to 1 on debt that actually wasn't marked to market on assets that weren't marked to market every day, like Bitcoin.
Right. And you can see like the liquidity in Bitcoin. You can see the risk. You can calculate the risk 24/7, 365. It's so incredibly transparent compared to anything that's ever existed before. And just in this test, right, the Bitcoin CAGR of 1.25% in the year 21-22, you're looking at a Bitcoin price of $300,000. Right, we've got people calling for $444,000 in 2025. Right? I know people are bulled up for $1 million in 2032. This is an incredibly bearish scenario, and they're still paying their dividends into perpetuity. And if it okay, and we talked about this on the hurdle rate earlier this week, and I think this is such a good point that Matt brought up. Right, let's say Bitcoin breaks for like something, so we have some tail event that breaks Bitcoin. It's not like institutional capital is immediately going to go running for the next crypto, right? Like they're not going to go run for Ethereum. If something breaks Bitcoin, it likely is breaking most cryptographic currencies.